Hello and welcome to Portfolio Matters. We have a treat for you today because we have special guest Stuart Owen. Now, it is towards the end of the tax year and Stuart is an old friend of mine who has a very different investment approach. He doesn't do the sort of spivvy stuff that you get from Richard and I, and regular viewers of our channel will know exactly what we mean. He is a serious long-term investor who invests in things which will bring a steady return and are much less volatile than the things that catch my magpie eye. And in particular, Stuart invests in VCTs and EISs. And as we are getting towards the end of the tax year, and we're all thinking about trying to save some tax, we thought it'd be great if we could get him on to talk about his experience. So, without further ado, Richard will read the disclaimer and then Stuart will tell us all about it.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. The views of any guests we may have on the show are entirely their own and may not be representative of the views of Portfolio Matters. A full disclaimer can be found at the end. So, Stuart, tell us about the VCTs and EISs that you have.
Thanks very much, Keith. Yeah, I've spent quite a bit of time and energy looking at tax-advantaged investments because a lot of my sort of steady Eddie stuff produces a fair bit of income, and that has some, obviously tax consequences. Just to say, for most people in the UK, this will be of interest because these investment schemes are only applicable under UK tax law. So just to cut to the bottom line, I would say these things are useful, but they are a sort of last resort. You definitely want to be doing your ISAs first, and then SIPs, because they're much more flexible and you can invest in the things, in a sense, you really want to. But if you do invest with EISs and VCTs, my experience is that with the EIS, the Enterprise Investment Scheme, that is, you really should use them very much as a sort of high risk, high return venture capital punt. You shouldn't be seduced by the packages that managers offer you of supposedly risk-controlled EIS exposures. Take the bet, but know it's a bet, is the bottom line, I think, on EISs. With VCTs, there have been quite a few changes in the rules, so I think most of the managers' track records are even less useful than usual. So I've ended up doing a really diversified splatter across managers that I think are credible. And within that, I would tilt towards the VCTs which invest in AIM-listed stocks. Okay, so to get into a little bit more detail, so what can enterprise investment schemes and venture capital trusts invest in? Well, under the legislation, they can invest in qualifying trades, which is pretty much anything, excluding property, hotels, farming, financial activities, and energy generation. Many of those trades were permitted under previous rules, but HRMC found that various sort of lower risk enterprises were being funded that really weren't the idea of behind these schemes. The investments can be unquoted or they can be listed on AIM. They must have gross assets of less than 15 million at the point of investment, so pretty small. Employees under 250. Usually the company must be less than 7 years old. So you can see it's small, innovative companies that are being targeted. There are some slightly different rules for companies which are deemed to be knowledge intensive companies. But you should be aware that the rules have been tinkered with quite a few times. So that's quite possible to happen in the future. But one aspect of that is that some of the portfolios you can buy into in VCTs have got exposure to investments which were permitted under the old rules and which have been grandfathered in. So the idea from the government in offering enterprise investment schemes and VCTs is to invest in small, high growth opportunities. And the come on to take the risk in those things are the tax advantages. So turning to those, for enterprise investment schemes, they really are very generous tax advantages. If you put 100 quid in, then you get 30 quid off your income tax bill, which you can apply to either this tax year or the previous tax year. You can also defer capital gains. So if you've made a capital gain of 100 and you put 100 into an EIS, the capital gains that you owe is deferred until the maturity of the EIS. Any growth that you achieve is tax-free. And if you do make a loss, then that loss is itself tax allowable. So if you put 100 quid in and it ends up being a total write-off, 70 is allowable against income or capital gains. It's 70 rather than 100 because the government says you've already had 30 by the income tax relief. If you hold the EIS for 2 years, EIS investment, then it's also eligible for IHT relief, inheritance tax relief. So this means that for a 45% taxpayer, even if the investment itself goes to zero, all the different tax advantages mean that your loss is only 38.5%. And obviously not welcome, but far less than 100. You must hold an EIS for investment for 3 years. Venture capital trusts also have 30% income tax relief and tax-free growth, and they also pay dividends quite often, and those are tax-free. But the other rules are less generous. You can't carry back to previous tax years. You can't defer capital gains. There's no inheritance tax relief or loss relief, and you must hold it for a minimum of 5 years before you sell it. So what's been my experience with these things? Well, the histogram on the left shows the returns that I've achieved on my various ones. So you can see on the far left, 12 of my investments have produced a return of between minus 80% and complete write-off. Conversely, there have been a few on the right-hand side of the histogram generating positive returns in themselves of between 20 and 40%. And then the largest amount have been basically sort of somewhere around break even. Now this is the result of 53 realizations so far. Now that may sound quite a lot, but some of the investments I was making in the early days of enterprise investment scheme might have been, for instance, 7 or 8 different solar panel farms, which are in a sense 7 versions of the same bet. Those investments themselves are no longer eligible because they're energy related. Now, most of my enterprise investment scheme investments were sourced via managers offering a sort of packaged pooled service that included companies like Ingenious, Oxford Infrastructure, Foresight, Rockpool, and Octopus. Now, that is a bit different from an alternative route where you can punt on a single company enterprise investment scheme. So the bottom line for me has been sort of marginally okay. So for every pound put in, I think I've got about 118 pence of value. So a pound going in, generating on average a 20% investment loss. So I'm down to 80. But then adding back 30 from the income tax relief that I got up front, and then another 8 pence from the fact that when you do make a loss beyond 30%, then that loss is itself tax allowable. So I think I've generated about 118 pence of value for every pound put in. So that's sort of been lukewarm okay. What I think is you need to compare it to, though, is the situation if you hadn't invested in the EIS, which is you would have had to have paid the tax, and you would be therefore starting from a base of 70p of capital, which you would have grown via whatever you chose to invest in. Obviously, if you invested in the NASDAQ, you'd be well ahead of the 118. if you'd have invested in the FTSE 100, perhaps less so. So that's the numbers on what I've got from my EIS investments. But I think people might also be interested in the reality of investing with them. The first thing to say is that to get all these tax advantages, you need to receive what's called an EIS 3 form. And these can be very long waits before you get them. So you could invest, perhaps in June, you hand over your money then, the manager is trying to make the investment and then get that investment confirmed by HMRC and get you an EIS 3 form back. It could be 12 to 18 months before you get that. The second thing to say is that although the minimum holding period is 3 years, so far for those returns which I showed on the previous slide, they took an average of 4.5 years between investment and return of proceeds. Now that's the ones which have actually paid back. There are others, of course, which are still ongoing. These are small companies that you're ultimately invested in. And I do have certain concerns about the oversight that the managers give to after they've made the capital investment. I'd say the reporting is late, brief, and evasive compared to what you would expect from a regular company. And I have had one experience of outright fraud with some nursery investments. The other painful truth is that the fees here are huge. Over 15% of invested capital disappeared in fees from these realized investments. That's quite a tide to be working against. I'd also say that there's an awful lot of paperwork. It's quite a sort of spaghetti to juggle these things. So it's nice to be able to carry back an income tax relief to the previous year when you know what your tax bill was, but that involves resubmitting your tax return, chasing HMRC, waiting for a repayment, and that can be, a case of blood out of a stone. I've also had cases where an EIS manager investing in AIM stocks sold some of those initial investments, but within the minimum holding period. Now they've sold them, made a nice profit, thank you very much, but in more paperwork, you've claimed an EIS relief, which is no longer permitted. So you have to write to HMRC, say this is what's happened, and pay back the tax relief which you'd already got. I've also had cases where, for instance, you might be issued with 100 shares in a company and 30 of them get sold. So you then have to do a partial recalibration of all the numbers. And finally, I'm beginning to suspect that some of the managers want to limp on with the investments they've made, whereas from an investor perspective, you'd actually rather that the loss was admitted, because then you can claim loss relief. But there's an incentive for the manager to keep extracting their fees and limping on. So that's the enterprise investment scheme experience. My experience with venture capital trusts has been a bit different, much easier paperwork. Very, very quick to get the certificates back to you that you need to claim the tax relief, within a matter of a couple of weeks, typically. Because you can't have used the income tax relief against your previous tax year, you have to make an investment within a certain tax year and have a good estimate of what your income tax bill is going to be. Another advantage of VCTs is that it's fairly easy to buy a fairly modest amount. It's not uncommon to be able to buy in units of sort of £4,000 or £5,000. So you can fairly easily diversify across VCT managers. I'd also say that I think that the VCTs get a more professional stock selection. There's a risk that the investments which come through to you in EIS form might be those which the VCT managers have decided that they don't want to take up. So I think you get better diversification because the VCT is itself a pooled fund. So it's not uncommon to have 40, 50, 60 investments within that, with, I think, a bit better due diligence done by the managers than one might be able to do for oneself. But having said all that, on the positive side, these are often very small funds. When I started looking at these 5, 6 years ago, there were funds of 20 or 30 million quid, and which were completely unable to create a diversified portfolio. There's also an awful lot of history of mergers and closures, so getting accurate data on the real performance is often quite tricky. In contrast to enterprise investment schemes, VCTs often pay a dividend. Now, they can be lumpy because the dividends are paid from capital gains on realized investments. Very rarely are dividends paid from income in the portfolio. So you tend to get large lumpy distributions, and I think about 5% a year is a reasonable assumption to make on what you might get back. So there is, in contrast to an EIS, there is a little bit of some reassurance by getting some cash in hand over the holding period. Having said that, big fees again, 2 to 3% going in, 2 to 3% a year, and often you're able to get out by selling the shares back to the manager at about a 5% discount to NAV. So again, a pretty heavy tide against you. I have found that some discount brokers can help take the edge off a bit. In particular, Wealth Club has been quite a useful website and service for getting what discounts are available. The other thing to say about VCTs in contrast to EIS is that after 5 years, you can just simply sell your units in the fund. So you can time that. I mean, if it's a bad time in the market, a depressed time, you simply choose not to. And conversely, a good time, you can choose when to exit, rather than the EIS just wrapping up whenever the managers of that fund or that company decide to. Within the venture capital trust world, there's two very broad categories. The first, venture capital trusts that invest in stocks listed on AIM. And I show here a chart of one that I've invested in, the Hargreave Hale AIM VCT. And you can see some pretty reasonable performance, obviously very volatile. I've preferred VCTs that invest in AIM stocks because I think that there's some risk reduction there. There are at least some company accounts which are public. There is some liquidity on the stock market, and there's some validation of the business model if they've been able to float. I mean, obviously, it's not super high quality, but there's some validation at least. I've found that they've generally performed fairly well in the past few years because they've got quite a bit of tech exposure. But equally, you can see in the chart here that does come at the price of some extreme volatility during the COVID shock, some very big price falls. So some particular funds that I found to be quite good in this area are Marty, Hargreave Hale, Octopus, and Unicorn, all of which focus on AIM stocks or have funds that focus on AIM stocks. The other big cluster of venture capital trusts are more generalist ones. These quite often do have a legacy portfolio under the old rules, including loan stock and pref shares that they've issued to companies, which provided a much lower risk position. And historically, the VCTs were able to fund MBOs. So that was a lower risk activity. So quite a few of the funds do have a legacy portfolio, which is gradually running off from those areas. So the rules have changed a couple of times to really focus venture capital trusts on truly venturing capital. So there is an issue of, are the managers up to it? So what my response to that has been to diversify my exposure across the generalist managers. So that includes Northern, Baronsmead, Proven, and Mobius. So to summarize, you can see that these things have got very attractive tax advantages, but they do come with big fees and non-trivial risks. So I would really definitely obey the conventional advice. Max out your ISAs, max out your SIPs before you come to this area of the market. If you do choose the enterprise investment schemes, which do have those great tax advantages, then get with the program. Do use them to bet on high-risk punts that you've got some conviction or interest in and expect a long holding period. It's almost like a sort of fire and forget thing. You know that you've got a high-risk option out there and don't expect too much. Then from the venture capital trusts, I would diversify because these managers are not proven yet, but you might want to tilt towards AIM stocks. So that's been my experience. I hope some of that is useful to you.
Well, thank you, Stuart. That's been absolutely fascinating and really, really useful. Would you mind going back to the chart of your experience, the summary? Because this is absolutely fantastic. This is lived experience, 53 investments. And actually, when you think that it's cost you 70 and your return on average has been 118, that is fantastic, actually. I mean, you're talking about a 50% return essentially over 3 years or 5 years, depending if it's an EIS or VCT. Now, the question I had for you is, can you get out? Because the way to maximize your return in, let's say, an EIS with a 3-year time horizon is that ideally you want to sell it exactly on 3 years, get your 30% tax relief, and then do it again. And so every 3 years, you are then getting 30%. But in my humble experience of these, you end up with a vehicle which, you're trapped in for years until it decides to wind itself up. What's your experience been?
Well, half and half. These are the 53 which have actually realised so far, which took about 4.5 years to pay back. So no one's paid back within 3 years, even though that's the minimum holding period. But I do have a long tail of residual EIS investments, which are like your experience, where you've got no way of forcing an exit. And if they decide to limp on, they can limp on. And you don't even get the loss relief. You're definitely at risk of that.
And the other thing I notice is that it either works or it don't. There's a very long tail, chunk at the bottom, which is gone, you've essentially lost pretty much everything, or the majority have actually worked. So, 0 to 20%, a lot of these VCT schemes aim to provide, 105 after 5 years so that you get essentially your tax relief, and that's about it. But I'm actually interested to see that some of them have done quite well, up 20 or 40%, but that none of them have been multi-baggers.
Indeed. And I think that's partly a function of how I did these in the early years, because I did invest in quite a few of the renewables focused ones, and there are also ones which focused on the reserve energy market. Neither of those areas are permitted anymore because they were deemed not to be genuine sort of startup risks, and also because the argument was there was 2 bites of the cherry. In particular, the renewables were also receiving what's called a renewables obligation certificate tax advantage. Yeah. So they're not permitted anymore. But I think you should invest, if you do invest in EIS, on a sort of hope for a multi-bagger, not using these sort of overly risk-controlled manager solutions. Right. I would be more focused on perhaps some of the university spin-out managers that look to back genuine startup, high-risk opportunities. And you should forget about 3-year holding period. It genuinely would be sort of 5, 6, 7-year holding periods.
Stuart, is there any commonality that you have with the 80 to 100% loss losers that you would say this is a category to best avoided?
Surprisingly, it was actually some of the energy funds were down there. One of the managers was setting up, there were diesel generators that were supposed to sort of kick in and provide very quick response electricity. But they managed to completely mess it up. I think the rules changed in the electricity market, and these things went to zero. Beyond that, fraud. So probably not.
No,
not too much commonality.
And you said this at the beginning, but this is a slow, steady process, isn't it? Where obviously, if you get a multi-bagger, that is great, but effectively you're accruing the tax advantage and income over a period of 3 or 5 years plus any capital gain, and you don't. It has to be an investment style where you put your money away and you don't need it, you don't expect to use it, and you're comfortable having it not accessible for a number of years.
Absolutely. There's no liquidity whatsoever in the EIS. You're completely at the mercy of the manager's decision about when to sell the company, how to exit. With the VCT, it is at least under your control after 5 years. But yeah, that is 5 years of being locked away.
Yeah.
Well, I have also done some EISs and some VCTs, and frankly, I've done far fewer than you. Now, the EISs, Richard and I have done some angel investing, which is ongoing, and we will do a special on angel investing in due course.
Yeah.
Needless to say, it's a mixed picture, which may or may come good. I have done one EIS, which is on a specific company, and that is looking actually really good. And it looks like it will return several 100%, hopefully in Q2 or Q3 this year. Obviously, Stuart, I take a bit more risk. It was a single stock on a gaming startup company that's designing video games. So actually that looks good. But my VCTs have been poor. I think on average they're going to. There's one is 110, but then there's one at 54, and so on average they're about 70. Now, so to summarize your experience though, going forward, what will you be doing?
I will be making my life simpler. I will not be doing too many EISs. The paperwork has been a bit of a spaghetti nightmare. I'll be biasing towards VCTs, and in particular the AIM VCTs.
Very good.
Okay.
Well, thanks a lot. That's been really useful.
Yeah, thank you very much, Stuart. Very, very interesting. Very, very cogently presented.
Absolutely.
Well, thank you very much. I hope it's been useful.
Well, it's been great. And if any of our viewers have experiences they'd like to share with the audience, and this is exactly the sort of information we would like to share with the audience, because this is the real lived-in experience of investors. So thank you very much, Stuart Owen.
Thank you very much, Stuart.
You're welcome. It's great to be on the show.
Thank you. And I think all that remains is to say, please, can you all subscribe to the channel, press like, and it's goodbye from all of us.
Goodbye.
Bye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website, or to any information, products, services, or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.